Good morning to the audience from Cornell University in Ithaca, upstate New York. On behalf of the Emerging Markets Institute and eCornell, welcome to this webinar, Crypto, How Digital Currencies will shape and are already shaping emerging markets. My name is Lourdes Casanova, and I am a senior lecturer and Gael and Rob Cañizares, director of the Emerging Markets Institute. While one would expect these major technological changes in the way we use money and handle currencies to start in the most innovative and technologically advanced countries like the US or Europe, the rush to adopt cryptos as legal tender and central bank digital currencies are happening in emerging markets. El Salvador, a dollarized economy for 20 years, adopted recently crypto as a legal tender. And also countries like Panama, Paraguay, Cuba, Venezuela are considering that. In spite of the critics he received, the president of El Salvador has announced that they want to launch $1 billion in bonds in cryptos. He also claims that crypto and the whole ecosystem he has launched of ATMs, digital wallets with crypto will help the population of El Salvador have access to better and cheaper financial services. It's not the same, but we see a similar trend with central bank digital currencies. The first one launched the e-Naira in Nigeria, but also Saudi Arabia and also e-Peso in Uruguay, and many other countries are looking into that. And by the way, some of these countries like China have banned cryptos, not only banning cryptos, but crypto mining cannot be done, and there was a lot of crypto mining done in China, cannot be done in China anymore. Why is this happening? Why countries like Panama, El Salvador, and on the CBD side, China and Uruguay are launching these new forms of payment? Why is that? On the one hand, emerging market currencies have caused havoc in these countries. They have caused ruin, tremendous inflation at times, debt defaults. Could be that the reason? Also, emerging markets have been very advanced in mobile payments. From M-Pesa in Kenya, that was launched in 2007, a collaboration between private companies and also the Central Bank of Kenya, to Mercado Libre, the e-commerce company in Latin America that has launched Mercado Pago. In Africa, we have another e-commerce company, Jumia Pay. And of course, in China, very prevalent, both Alipay and WeChat Pay. So could be this experience in the population in using mobile payments have prepared the population to be much more prone to the move to digital currencies and cryptos. And then, more broadly, what will be the far-reaching consequences? Will central banks, in the case of the adoption of CBDCs, become retail bankers? And what will happen with the rest of the banking sector? What will happen as well with the role of the governments? In both cases that I mentioned, cryptos in El Salvador or CBDC in China or in other places, the government keeps a tight control, and it's a little bit counterintuitive because crypto is supposed to be decentralized finance. The governments keep tight control on these experiments. And we have a great group of experts from the IMF to help us find some light into these very, very new ecosystems. So we have Dimitris Drakopoulos, who will be covering cryptos, Parma Baines, who will talk about regulation And Gabriel Soderberg, who is also a colleague, besides being at the IMF because he's a professor at Uppsala University, will cover central bank digital currencies. We will start with the introductory remarks of each one. And the first one is for Dimitris. So what are the drivers of this early adoption of crypto in emerging markets? Dimitris, the floor is yours.
Thank you very much. So I'll start sharing some slides. As you may know, IMF and the World Bank have annual meetings in October and April every year. And back in October, we did, as part of the GFSR, a presentation on crypto, a chapter on crypto, sorry. And I'll present some slides from that. And a lot of it touched on what I would call today cryptoization. So the chapter covered a lot of issues that we will not go through today. Partially, Parma later on will discuss, especially about some of the regulatory and vulnerabilities of the crypto ecosystem. But what I will focus more is on issues related to macro-financial risks and especially how these are affecting emerging markets. So before we go there, just a quick point. On the left-hand side, you see the market capitalization of crypto assets. It was a dramatic increase in 2021. We went from $700 billion up to $3 trillion at some point in November. We have dropped around 2 trillion now, 1.9. But these large swings obviously brought a lot of speculation in the asset class, but also brought the asset class in the eyes of the regulators because we also saw very large adoption happening in emerging markets. So why did this adoption happen? So you cannot point to one driver. Each country had different regions where adoption started to happen, and I won't be able to go through each and every one of them. But I would say that there were pull factors. One was the dramatic returns that we saw in 2021, where a lot of people were driven to buying anything from Dogecoin to Shiba Inu or just Bitcoin. The relative transaction cost and speed, that might not sound so familiar to you if you are trying to transfer money in the US or in the Europe, but if you're trying to transfer money in Nigeria or other countries where the payment systems are, let's say, less able to communicate with other countries and slower and have other problems relating with the settlement of currencies, crypto assets offer the solution to some of these countries. The issue of AML and safety standards, that's what we call anti-money laundering and countering financing of terrorism. This also is an issue which we might touch, especially now with what's happening in Russia, in terms of being able to bypass certain restrictions. And there were also important push factors. Countries with unsound domestic macro policies, for example, one country that has seen a lot of increase in crypto asset trading has been Turkey over the last year, especially around episodes of volatility in the exchange rate, vulnerability in the banking sector when domestic residents are afraid that their money in the bank might not be as safe. Maybe they see, let's say, stable coins as a better way to put their deposits. Also, financial exclusion. It's much easier for some people to just use their mobile than get a bank account in some of these countries. And crypto also provides a path to financial inclusion in some cases. So how do we measure this? One thing you usually get to see is these surveys. And these surveys just ask how many people are using crypto assets in these countries. And usually what you get to see is that emerging markets are at the top. But this, for many reasons, is not a very reliable indicator. Another thing you could do is you go and see in some of the famous websites of crypto assets companies, where do the clicks come from which countries? The flags are cut a bit here, but you could see that Binance, which does more than 50% of the crypto trading flows, the first two visitors, at least from the way some companies measure the IP addresses, come from Russia and Turkey up until June. Also, Brazil and Argentina were very high. And the same for some other global exchanges. Coinbase and Kraken are more based in advanced economies, but you could see that other exchanges, again, have a dominance of emerging markets. There are other ways to measure how adoption was going on. You could see exchanges measure the volume of traded volume in exchanges which are registered in emerging markets, especially in Asia. There are a lot of domestic registered crypto exchanges. And there you could see that there have been cases, this on the left-hand side tries to measure the amount of volumes compared to the equity volume in that country. And there are countries, especially in Asia, where the crypto exchanges do more volume than the equity exchange. You could also try and see how much traded volumes occur in the pairs which are emerging market versus crypto. And this is what on the right-hand side happens. And there you could see, for example, in Turkey, traded volumes against, which is part of the sample here, traded volumes against crypto exploded back in January 2021. And also, actually, this was also Nigeria back in January 2021. There have also been some other incidents this year where crypto trading volumes were significantly higher compared to the size of the exchange rate market. Finally, I will not go into this unless it comes on the Q&A, but the basic point here is that the price that emerging market users pay to buy crypto assets is not the price that you pay when you use Coinbase or Binance in the US. And the reason has to do a lot with capital flow restrictions and other issues that create, let's say, market segmentation in the price discovery. And this also is important to policymakers, but I will not go too much details. And the final point I want to make is another part of the adoption has come from mining. A lot of emerging markets, initially it was China, but then Kazakhstan, Russia, over the last year especially, have realized that a way to generate a large amount of revenues is to use some of their energy resources towards mining. And a lot of the crypto asset mining has migrated. Even after they left China, they went apparently to the US and some advanced economies, but in reality is that the bulk has remained in emerging markets. And there is a lot of anecdotal evidence that even in China, there is still a great amount of crypto asset mining. I will leave it at that, and I will pass it on to Parma for discussing some of the regulatory issues. And I guess we will come back to some of the cryptoization issues in the Q&A.
Cheers, Dimitris. I want to talk, Dimitris has spoken about some of the drivers. So what I'm going to try and do is cover some of the risks around consumer protection, around market integrity, and around financial stability. Now, if you just want to take a look at the chart on the left-hand side, when we think of distributed ledger technologies like Bitcoin, when we think of crypto assets, the two things we think about are decentralization and disintermediation. But the truth is, this is a really good example. There's several entities over the past few years that are new types of intermediaries, and these are centralized intermediaries that are built on top of these decentralized networks. And most of these intermediaries are terms you'll be familiar with, so crypto asset exchanges, crypto asset wallet providers, and they come with all of the risks that these centralized intermediaries bring, right? So the single point of failure risk, risks around cyber resilience, risks around operational resilience. And, they can stop people buying and selling crypto assets if they so wish. So everything that these decentralized markets were looking to achieve, these distributed markets are looking to achieve, these entities are able to, I guess, stop some of that idealism. And many of these entities, many of these exchanges, many of these wallet providers, they reside in offshore jurisdictions. And you can see that roughly 3/4 of trading activity of exchanges happens in these exchanges that reside in offshore jurisdictions. You see, the problem is that they're able to market their crypto assets globally. So I could be sitting at home here in the UK, and I can access crypto asset services that are being provided by these exchanges that are headquartered in offshore jurisdictions. And many of these offshore financial centers, they might be tax friendly, they might be regulatory friendly. And that becomes slightly problematic from a consumer protection perspective, because let's say me or you, we've got some money stored in one of these wallet providers and someone hacks these wallet providers. What recourse do we have? It's very little, right? Or if there's an operational failure and we aren't able to trade at a certain price or exit our positions at a certain price, again, what recourse do we have? Very little. And the truth is, these types of consumer protection issues, they can affect people globally, but domestic regulators might not have the supervisory or regulatory oversight to take enforcement action should something go wrong in these exchanges headquartered in offshore financial centers. So that's certainly one side. But if you look at the right-hand side, another risk is around data. Now, in the crypto asset market, data is frequently unavailable. Where it's available, it might be inaccurate. And where it's inaccurate, it might not be comparable across jurisdictions. And, this chart on the right-hand side is a good example of this. 7 different blockchain analytics firms were asked the same question, and they gave 7 different responses. So they were asked, what proportion of Bitcoin transactions occur peer-to-peer? Right? So one of these firms said, was almost 100%, right? Almost 100% of Bitcoin transactions occur peer-to-peer. But the same question asked to a different blockchain analytics firm, the other firm said, well, it's negligible, it's almost 0%. And that's a bit of a problem, right, for authorities. When authorities are looking to understand what potentially the size of the crypto asset market might be, when they're looking to determine what sort of risk might exist in their domestic markets, and when they're looking to identify what sort of regulatory response needs to happen. Dimitris, do you want to just move on to the next slide? And I've spoken a little bit about hacking already for centralized exchanges. The truth is, I think because it's got a lot of press, these centralized exchanges losing tens of millions of dollars worth of crypto assets over the years, a lot of them have spent a significant amount of money beefing up their security. And what that means is it's becoming more and more difficult to hack these centralized intermediaries, but they are still centralized intermediaries, right? So a lot of the hacking has moved into DeFi networks. Now, I don't want to talk too much about DeFi today, but certainly if it comes up in Q&A, we can address that there. And on the right-hand side, we look at some of the volatility around crypto assets. Now, these are some of the meme tokens that took off last year. And you can see the market capitalization of some of them. Now, even the founder of Dogecoin said, look, hey, this is a bit of a dope token. But when your market capitalization is approaching these levels, that's pretty serious if you ask me. And there's issues here around market integrity, right? So when you're looking at some of the more, I guess, illiquid types of crypto assets, those that are traded less frequently, well, they're susceptible to pump and dump schemes. So a group of individuals or a group of entities might get together, maybe on a network like Telegram, and make a concerted effort to push the price of one of these illiquid crypto assets up, and then exit their position as soon as the retail money starts entering. And then you've got a lot of outsiders that are potentially holding significant losses. Dimitris, if you just want to move on to the next slide. Let's skip this for the moment because DeFi is slightly different. But again, if we get the questions, happy to address them in the Q&A. The final thing I want to talk about is around potential risks to financial stability. When we think about that, we think largely about stablecoins. So stablecoins are crypto assets that aim to stabilize their price value by some form of stability mechanism. Right? So that stability mechanism could be, and most popularly is, for every unit of stablecoin issued, there's a unit of fiat currency, usually $1. But these stable coins, they could be backed by several fiat currencies, they could be backed by commodities, or they could be backed by other crypto assets. Now, when you look at the growth of the crypto asset ecosystem, the chart on the left-hand side shows that at least over the past couple of years, a significant driver of this growth has been the growth of stable coins. And the largest stable coin, the one shaded in pink here, is Tether. And you can see that it's got sort of a significantly dominant market share. But if you look at the chart in the middle, you can see that although it sort of aims or aspires to be backed by fiat currency, in truth, it's backed by different types of financial instruments like commercial paper, like corporate bonds. And if there were to be a loss of confidence and potentially a run on a stable coin, it wouldn't be easy for the issuer to unwind their positions in these financial instruments. It might be difficult for users then to redeem those stable coins quickly and at par value. Now, if these stable coins were to grow to systemic levels, you can certainly see where financial stability risk would reside. And I just want to take sort of a second to talk very quickly about some of the regulatory responses that are occurring with these risks. Because regulation and authorities in general have a bit of a fine line to walk. What you want to be able to do is balance the benefits, the undoubted benefits that distributed ledger technology brings, certainly certain types of crypto assets bring, but you want to manage some of the risks that we've just covered here. And authorities are taking different approaches. Some are banning crypto assets, some are creating regulations, some are just waiting and watching. Now, at a global level, some work's been done, but the focus has either been on certain products, like global stablecoins, or on certain sort of sectors, right? So either payments or securities or banking, but the cross-sectoral standards, at least at a conduct and a prudential level, don't really exist. So on the banking side, the Basel Committee on Banking Supervision has consulted on the treatment of crypto asset exposures that banks have, and it's proposed splitting crypto assets into two broad categories. The first category would be safer crypto assets, types of tokenized assets, and potentially some types of stablecoin. And then a second category of riskier, more volatile assets, your Bitcoins, your Litecoins, your Ether. And what they're proposing is certainly for banks that are exposed to these crypto assets, different capital requirements for different categories of crypto assets, certainly a more conservative treatment for that second riskier category. And then, of course, IOSCO has done some work to determine whether principles for financial market infrastructures might apply to systemically important stablecoins. And then the Financial Stability Board has done some work publishing 10 high-level recommendations that look to sort of cover the regulatory challenges that some of these stablecoins brings. And of course, there's been approaches at national level. And again, if we get those questions in the Q&A, I'll be really happy to speak a little bit about that. But Dimitris and I, we've spoken a little bit about these privately issued stablecoin, crypto assets like stablecoins. These are the ones many of us are familiar with. But I'm going to pass over to Gabriel, who's going to talk a little bit more about digital currency that's issued by public.
Thank you very much, Parma, for that excellent presentation to Dimitri as well. So I will talk a bit about here central bank issued digital currency, CBDC. So we could start with what is that? And as the name implies, it is simply digital money issued by a national central bank. So in that sense, it is like a digital form of cash. And if we are moving into a digital era, it's logical for central banks sooner or later to start thinking about, should we do the same we've been doing with cash for hundreds of years, and to do so in digital form. So it seems, though, that just since CBDC are digital, it's the D in the name, and this means also that it's different from physical cash. It has different qualities from cash. And what does this mean? What are the implications of CBDC being digital, and what's then the difference between the cash issued by central banks? What are the implications? And this is very much now explored by central banks, both in terms of risks. Would there be risks involved in issuing this? And also, what would be the opportunities of this? Can we do things that we haven't been able to do before? And could it supplement the ongoing digitalization of our countries and indeed the global payment system? So where are we today then? So we see that most countries in the world today are to some extent looking into central bank digital currency, but they do so at different stages. Two countries, Bahamas and Nigeria, have issued formally CBDCs at this point, and Bahamas and Nigeria. And Bahamas has currently 20,000 wallets in a population of around 400,000. Some countries have issued advanced stages of pilots in which CBDC is circulating in society, but as part of a trial. And especially the Chinese pilot is very large. The last official numbers that we have is over 140 million wallets. Some figures suggest closer to over 250 million. So we will see if we get those numbers confirmed eventually, but it is a very big pilot. And a number of other jurisdictions are also doing this. So why are they doing this? So there are a number of different policy goals for looking into this. And you could say roughly they fall into two categories. One is simply modernization. They think that modernization is going too slow in their respective countries, and they think that CBDC could serve to help modernization, help digitalization ongoing. The second is future-proofing. So we see risks arising from rapid digitalization. So jurisdictions are looking into the question, could issuing CBDC be one way to mitigate some of the risks that arise with that. What we see also is that you spoke about earlier, Lords. You spoke earlier about what will be the impact on banks, etc. What we see is that central banks do not want to disrupt the traditional financial sector, so they are designing their CBDCs and their CBDC pilots to do as little, compete as little as possible to bank deposits. And also, all of them are looking into so-called intermediated or two-tier models in which private firms are the intermediary between central banks who issues and the end user who uses the CBDC to make payments. And I think I'll stop there as soon as possible because I'm really looking forward to the discussion and all the questions.
So plenty of questions. Thank you very much, Dimitris, Parma, and Gabriel for these great introductory remarks, and where you have answered many of the questions. We have plenty of questions from the audience already coming. So I'll pass the word to two students from Cornell, Mihika Bajate and Ravin Nanda. Both are at the College of Arts and Science here at Cornell, and both of them are research assistants at EMI who will handle the Q&A part that is going to be very rich and very interesting. Mihika, Ravin, the floor is yours.
Thank you, Lourdes, and thank you everyone for taking the time to be here. So my first question is to Dimitris. Can you tell us a few more ways to measure cryptocurrency assets and the adoption in emerging markets? And can you also explain why you think that adoption is higher in emerging markets as compared to developed countries and markets?
Sure. So I already talked of a few data ideas. One is looking at the transaction volumes in exchanges that are registered in a specific country. Unfortunately, as Parma highlighted, a lot of exchanges are not registered in some of these countries, and they are registered in Gibraltar, Malta, and all sorts of other places and do offshore transactions. Another method is looking at the trading volumes against a specific currency, so against the Turkish lira, the Nigerian naira, and so on. I think is very important to highlight that in order for a user to go from his local currency to crypto, he needs to be able to find a trading market where he can sell his currency and buy the crypto. Right? So it's also the most important, let's say, as people call it, on-ramp, where you can sell your currency and buy crypto. And if you don't have these on-ramps, then you cannot go to crypto that easily. Now, the third method, which I think is quite common, but it's also problematic for reasons that Parma mentioned, and we can expand on, is blockchain analytic companies. Blockchain analytic companies try to map the residency of wallets using certain techniques. Some of these techniques might be, for example, if that wallet was initially transacting before the money were transferred, that person was transacting in a local currency, let's say the ruble, then that wallet eventually might belong to Russia. There are other techniques as well that they do. So these companies try to map the residency of wallets, and they create a measurement of how much volumes are transacted by these wallets based on residency. I didn't present this data here. I think personally, I don't think they are very reliable, but that's a very common. You have seen perhaps reports by Chain Analysis in some other countries. It's not that they are not reliable per se, but I would say they are not comprehensive enough in order to be used for, let's say, for macroeconomic type of analysis. And finally, we have the surveys, which I think I briefly discussed. And I think the surveys are, it's obvious that some of the surveys are not have adequate samples. You could see that, a survey company might be from Australia and end up having Australia as the second user of crypto assets because they probably had a different type of sample in the country that they made it. So yeah, I will stick to these four methods. And actually, a final point is that apart from Brazil and a few other countries, no official data exists. No country has tried to produce data of crypto asset transactions. For example, how they affect their balance of payments. So I think Brazil is one exception, and I haven't found many others so far. So that data avenue of official country data does not exist yet.
Thank you. I'm going to move on to a question for Parma, just for time. But I wanted to ask, how should authorities, should they ban crypto assets, and how could they, regulate or ban or just kind of monitor crypto assets? I know you talked a little bit about this, but I think given everything that's going on right now, I think it would be interesting to go into further detail on it.
Cheers, Mihika. No, that's a good question, super relevant right now. So, personally, I'm not going to say that that's one position. Personally, I'm not entirely convinced that bans are the way forward because of, what I said initially, right? What you want to try and do is harness the benefits, the very real benefits that some of these new technologies and potentially certain types of crypto assets have. But you want to manage the risks, right? And with banning, I think there's several challenges. First of all, it's not really proportionate. Second of all, even where you do implement bans, there are ways to circumvent those bans. Users can use VPNs. We've certainly seen that happening to sort of hide where they're sort of interacting with the crypto asset ecosystem from. And even where these bans have been implemented, or at least restrictions have happened to a very strong degree, we still see that in those jurisdictions, citizens are still holding crypto assets. So Egypt's a really good example, right? They have very strict restrictions on who can buy or sell crypto assets, yet almost 2 million Egyptians hold crypto assets. Now, Demetrius has spoken a little bit about the challenges of accurate data, and I've mentioned that too. So we don't know how accurate that number is, but certainly some evidence suggests that there's an active crypto asset market there. So it's very, very difficult not only to implement bans, but to actually police those bans over a long term. Over a longer term, I think a more proportionate regulatory framework makes a little bit more sense. So when we talk about what regulation might look like, what you want to do is provide a level playing field across the activity and risk spectrum. So for those entities like wallets, like exchanges, these centralized intermediaries sitting on these decentralized networks, what you really want to do is provide some form of conduct and prudential regulation on these entities. So they have to be licensed or they have to be authorized. That just makes sense from a consumer protection perspective, from a market integrity perspective, and then from a financial stability perspective. We've already seen, again, when we think about financial stability, stable coins are usually seen as perhaps the element of the crypto ecosystem that could generate some of these risks in the shorter term. And we've seen some steps being taken. I've spoke a little bit about those steps at a global level from the FSB and from IOSCO. But even jurisdictions, so the US recently proposed, the President's Working Group on Financial Markets, proposed that potentially certain stablecoin issuers might be subject to bank-like regulation and everything that comes with that, right? So your capital requirements, your liquidity requirements, your resolution requirements. And then in Europe, you've got a slightly different model, and certainly one that I think, reflecting personally, makes a bit of sense. Because when we talk about regulation, we talk about proportional regulation, you need to really understand what the technical specifications of some of these crypto assets are and their use cases as well. So the Markets in Crypto Assets legislation, MiCA, proposes, and it's still being proposed, that perhaps where tokens are being used for payments at a small scale, they might be subject to regulation similar to e-money payments regulation. Where they look a bit more like securities, they might be subject to securities regulation, the so-called asset reference tokens. And where they grow to a sort of a systemic nature, maybe then they might be subject to more bank-like regulation. But again, you need to bear in mind that many of these issuers, at least with their current business models, aren't carrying out some of the activities that banks are, like maturity transformation or extending credit. So again, I think there's a lot to think about there. But hopefully that answers both of your questions.
Thank you, Jan.
Yeah, thank you so much, Parma. And I'm just going to pass this off to Gabrielle. My questions is, are CBDCs, central bank issued digital currencies, a form of cryptocurrency? And do you mind explaining the differences between the two? And just follow up on that is, how do you think CBDCs could potentially help emerging market countries?
Yeah, So it's quite important to say that CBDCs are not crypto, and I think there are a number of things that's different. First of all, so there is some central banks are using or looking into using technology that is similar to the ones used in crypto assets. But some central banks are exploring using CBDCs that are not based on the same technology, but based on basically traditional technologies, centralized technologies. So there's nothing technologically that connects per se crypto assets to CBDC. The second is the question of issuance and how to manage the value of it. So obviously, a central bank digital issued currency is issued by a national central bank, and that's also controlled by the mandate of the central bank in most countries then to uphold a sustainable level of purchasing power, which is basically, so if that deviates, the central bank should ideally then intervene and to do that. Of course, there are countries in the world where that doesn't happen, and that's a problem in itself, but that's a commitment from the state to maintain the value of it. If you compare to more pure cryptocurrencies, the value is fluctuating according to supply and demand. If people sell a lot of cryptos, the value goes down. If people buy a lot, it goes up. And that's why you see it fluctuates quite a lot, which is what interests some people from it, because you can have very rapid increases in value, which makes it attractive as an investment for some people. The other is and you have stable coins, which has, I think this is the slide that's is up now, in which you have either algorithmic that stabilizes the value, or you have a basket of assets which are typically chosen to be stable, so that should stabilize the value. But then you have a private issuer, which is different in some respect in many respects, fundamental respects from the central bank. So I think these issues are the things. So they're fundamentally different, deeply different. And then the question is, what can it do for emerging market countries? I think this is a good question, and it's a question that each emerging market country themselves must look into, because it might well not be able to help all countries. Each country must look at their respective challenges. What are the challenges facing that country? Typically, what we see is that emerging market countries that are very interested in CBDC are looking into it to help accelerate modernizing and making their payment system more efficient, because they find that the private sector development is going too slow, and they want to help the private sector through issuing CBDC as an open platform for private firms to operate on, to ensure that there's a level playing field, etc. And they want to ensure that there is an open competitive market, and the best way to do that is to build CBDC as an open platform, and firms can freely enter there and compete with each other and offer new payment solutions. Some of them also are interested in making sure the payments are more resilient. They want also to increase financial inclusion through increasing digital payments, which then connect to financial services, easy to connect to financial services. But again, this doesn't necessarily hold for everyone. Each country must themselves look into what their challenges are, and could CBDC be one potential tool among other tools to do that. So I think I'll leave it there.
Thank you so much, Gabriel, and everyone, for your answers to our questions. We have a lot of really great questions coming in from the audience, so I think we'll transition over to ask you some of those. Revan and I will just go through the questions, and whoever wants to can kind of jump in and answer. So I'll start out with a question, which is that what do you think are the primary regulations that will come from the recent White House executive order on crypto? So anyone can pick that up.
Perhaps I can split this with Gabriel, because I think there's a CBDC element that's most important from the recent executive order. But I think what I want to sort of refer, the very good question from Monica too, is actually something that happened a couple of months ago, which was the President's Working Group on Financial Markets. If you want to sort of understand where the US is thinking of going with their crypto asset regulation, I certainly think that that's a good place to start. And again, you know, it's an eminently sort of sensible proposal for delivering robust regulation. and potentially imposing bank-like regulation for stablecoin issuers of systemically important tokens. But then there's always, the level below, so the detail that sits underneath those regulations and how they might apply to some of the more, I hate using this word, but traditional crypto assets like Bitcoin, Litecoin, and Ether. Because as I said, with most of these exchanges and wallet providers that facilitated the trading and the storing of these crypto assets, they're located in offshore financial centers. So it's very difficult to create that supervisory oversight without first onshoring those crypto assets. And that's something that the European Union is looking to do as part of its MiCA proposals. But again, I'd certainly refer Monica to the President Working Group's report.
Great. Thank you, Parma. And just a follow-up question on that, also directed to you. If crypto assets aren't regulated, aren't they a potential source of tax avoidance? What are your thoughts on that?
So I don't want to talk too much about tax. That's slightly different to financial regulation. Crypto assets can be used both ways, right? And when we look at what's happening in the news now, they can be used to facilitate what we perceive as good, and also what we might not be too pleased with as well. At the end of the day, tax is a different beast to financial regulation. So probably out of scope for today. But you're right. There are some challenges with crypto assets that at least tax authorities should be considering. But I'd consider that a question for tax authorities rather than financial.
Great. Thank you. And to any one of our panelists, what do you think causes cryptocurrency analysts to have different data interpretations of peer-to-peer transactions?
Okay, perhaps I can have a go at it. I think I was a bit overly dismissive of what these companies do on analyzing the transactions. It's not that we can offer something better. In many cases, they are the state of the art. At the same time, it's very difficult for them first to map enough blockchains. As you know, there are over 10,000 different crypto assets, and not all of them are a different blockchain. I think a vast majority of them trade on Ethereum. But again, even mapping all the different blockchains that exist is difficult, and being able to track them. Then finding the correct residency of these users is a problem. One problem that actually creates specifically relates to the question per se is that the wallet, we don't know whether it belongs to a service or to a single user. So if it belongs to a service, and by a service, for example, it could be a crypto asset exchange, the transactions that happen on that wallet have nothing to do with a specific user. They could be an aggregation of many users. They could be a transaction inside the exchange for some reason that has to do something that, a regulation reason, I don't know. So they transfer money between one wallet to the other. The companies that observe these flows, they do not know exactly who that wallet belongs to. So in some cases, they might map it as a peer-to-peer transaction. In other cases, they might say, no, this is this exchange transacting money with this exchange or internally. So, there are considerable measurement issues that they have. Perhaps I should have started from the obvious, right? That the whole crypto asset, the blockchains are what they're called pseudo-anonymous. They're not fully anonymous, but there is enough degree of anonymity to make it difficult to be able to map whether the user is an individual, where is he based, or he's a service, or he's something else. So I would say that are the main reasons.
Thank you. Another question directed to anyone on the panel. As crypto becomes more widespread, will the US lose its position as the reserve currency for most of the world?
Maybe I could take a stab on that, perhaps, because we are looking. I've been looking into the question. So first of all, we need to think about what does it mean that crypto gets established. I think again, do people use it? I think use or own. What do they do? Do they use it to make payments, or are they buying it for speculative purposes? And I personally see no case for at the moment that people are using crypto as a means of payment to a large extent. You can certainly use it, But I don't see any data that supports that this is what they're doing. So I think the adoption we might be seeing is from firms also. That's the thing, that they want to increase the risk in their portfolio, so they add crypto assets. So I can certainly see that happening, that we will see more widespread adoption in portfolios, and you add that in order to create more leverage into the portfolio. But the other question is, of course, what will happen with the US currency if other countries issue CBDC, and would this be a challenge to the US hegemony when it comes to the dollar? What we do see historically is that it takes very, very much for a currency, once it has been established, to lose its position. So the conditions, because once it's established, you have all these network effects, you have all these habits, etc. So it takes very much for that to happen. So it seems unlikely that only that would mean that there is a shift. On the other hand, you might see smaller shifts in different regions if it is the case that the foreign CBDC, the other CBDC, has some competitive advantage. For instance, ease of access, user friendliness, that gives it a competitive advantage just versus the dollar. But we don't see this as crucial possibility right now. That is something that takes longer time to happen. And again, the establishment of the US dollar goes back to after World War II, with very, very particular circumstances, in which the United States had around half of the world's total GDP. So it takes a lot to establish a dominant reserve currency. That's, I think, sums it up.
Great, thank you. And our next question is, again, to any of our panelists. How do you see regulations evolve in crypto with respect to sanctions evolve? And do you think that exchanges and wallet providers are equipped to manage these sanctions overnight?
Okay, perhaps I can take a stab, and maybe, I don't know if Parma wants to add anything. As you have seen, a lot of the crypto exchanges and the wallet providers, where even if regulatory frameworks do not per se exist for some of them, or at least comprehensive enough, they were proactive to implement the sanctions themselves. Some of them completely blocked users from Russia. So the exchanges themselves, and in general the crypto asset providers that want to, let's say, remain within the legal sphere, they have been proactive not to cause problems so far. But then they are also non-compliant crypto asset providers, and they are probably one of the places where some of the circumvention of capital flow management measures happens, and some of the sanction evasion happens. And it's very, very difficult to measure, because we don't have the KYC of the clients that these providers have. We don't have data on that, and maybe the authorities cannot get that data on that. Another related issue is that the technology is also evolving. There's the use of mixers, there is obviously peer-to-peer, there is all sorts of other methods that people can use outside exchanges, and their regulation is very difficult to do anything. So that's definitely, I think, an area that we need to look at more on how the regulatory framework can help on that side. So I will leave it on that, on sanctions. Just actually another point is that on the exchanges, if we go and see the volumes that are happening now on the ruble and the Ukraine hryvnia, they are not that high. They did spike a bit after the invasion in late February, but the amount, sheer volumes in millions of dollars, it's not something that I would say it's a major source of concern. In fact, Russia had done bigger volumes a few months ago. So it's clear that a lot of these exchanges that we can measure their activity either are unable to onboard the local currency in order to convert it to the foreign currency. That could be one of the drivers, and it could be because they have blocked a lot of users. Or the market is not deep enough to do this transaction because of problems in the exchange rate market. So there's a lot of this is a very active topic now, and probably we'll have more to say as the IMF later on. But I will leave it to that for now.
Thank you. Another question for any of the panelists. What are your opinions about companies that are popping up selling their services to mine crypto for the consumer, specifically companies like NiceHash and the Genesis Mining? Are they safe, and what precautions can we take to protect ourselves?
I'll leave it to Parma because I don't know about the specific companies. I know there's a lot of companies also in the staking business, which is also a mining type of thing, which also have some risks, but I'll leave it to Parma perhaps.
Cheers, Demetrius, for leaving me with the difficult ones. Now, obviously, I'm not going to comment on specific companies, so apologies, Tony. I won't go into that. But in terms of what precautions you can take, this is the problem with crypto asset markets at the moment. Without regulation, both conduct and prudential, it's very hard to determine which companies out there are legitimate and which companies out there are not. And certainly that's one of the reasons that it makes sense to have some form of regulatory perimeter over certain activities that some of these centralized intermediaries carry out. Now, I'm not saying that mining should or shouldn't be regulated, but certainly having the open register that many financial services regulators have, where you can just check to see whether you as a consumer would be protected if you interacted with this firm, I think is a very important element of consumer protection. And I think that sort of is quite important, because earlier this week there was, we talk about mining, a vote in Europe by a certain committee of the European Parliament to potentially outlaw mining. So the activities around a certain type of consensus mechanism, proof of work. Now that didn't go through, but I think it's very interesting to follow that debate around mining. And I know Demetrius has some interesting sort of observations around some of the risks that miners have, whether it's mining or whether it's staking. But again, without conduct or prudential regulation, I think that's one of the reasons that we think that it makes some form of sense.
Great, thank you, Parma. And our final question is, where do you see NFTs fitting into global markets relevant to cryptocurrencies?
Perhaps I can start just from the perspective of regulation, right? And then I know Demetrius and potentially Gabriel might speak from another perspective. See Demetrius saying no. So from a regulatory perspective, and again, I'm going to speak from a personal perspective, this isn't necessarily fund position. But when you sort of look at the types of things that the NFTs are looking to achieve right now, use cases can evolve, they can change over time. But when we look at right now, the actors involved, the types of risks involved, the business models involved, the regulatory response would potentially be slightly different to other types of crypto asset markets. Now, again, personally, I think there's these core services of crypto asset exchange, these centralized wallet providers, these centralized exchanges, where many regulators haven't taken the steps there to mitigate risk to consumers, to market integrity, and to financial stability. And that's a good first step to take. When we start looking at NFTs, you're looking at a new part of the market. Hey, it could be around forever, it could be a passing fad. We don't know that yet, right? But certainly it's not at a level where I think it warrants financial regulators sort of building a bespoke framework around these NFTs. That's one. Secondly, and I think quite importantly, they're fairly different. At least the main use cases now. Again, I know use cases can evolve over time. Right now, they're quite different from some of the more fungible crypto assets that you see in the market. By being non-fungible, they're broadly, at the moment, mainly collectibles. Now, if regulators are taking a tech-neutral approach, I'd ask the question, would you regulate Pokemon cards? Probably not, right? Now, I'm not saying that's the only use case of NFTs, it's not, but when we're looking at the broad use cases right now. So therefore, I'm not sure that makes sense. Now, there is a question, if you fractionalize non-fungible tokens into their constituent pieces, those constituent pieces might become fungible, and they start looking a bit more like financial instruments, like potentially collective investment schemes, especially if they're managed a certain way. Now, that's a separate question. With the NFTs as a whole, I think really for financial regulators, there's more pressing and immediate issues. And again, I just want to go back to one of the earliest points that I made here. Building that a sensible, proportional regulatory framework is important. Bans don't work over the long term. They might work over the short term to limit specific use cases that might worry you. But I think we really need to just focus on the core bit of crypto asset markets and not get distracted by NFTs and other elements. Not at the moment, anyway.
Great. Thank you so much, Parma. And before I pass it back to Lourdes, I just want to thank all of our speakers for taking the time to speak to us about cryptocurrencies and sharing their expertise. And just want to give everyone one last chance to say anything else that they want to say in the webinar.
Starting with who?
Dimitris, the same order.
Sure. I think Lourdes at the start mentioned the issue of dollarization. And you will see in your economic textbooks what dollarization means, where users substitute either for a means of exchange or a store of value or a unit of account, their domestic currency with another currency, usually the dollar. And this has implications. You lose monetary policy independence. You might lose seigniorage revenues for the central bank. And that's what we're trying to discuss with cryptization. See to what extent this phenomenon, instead of happening with the dollar, happening with cryptos, can create these type of problems, the macrofinancial problems on the monetary policy, but with the additional problems that I think Parma to some extent covered of market integrity, financial integrity of some of the institutions that offer the services. So, I think this is still a work in progress, partly because the adoption is not that large yet. And there are not that many cases where we see the same degree of cryptoization that we have seen dollarization. But this is definitely an area that we will continue looking at. And there are signs in some countries that there are significant macrofinancial risks that are starting to pop up.
Thank you very much. Gabriel, any closing remarks on CBDCs?
Parma is first, I think.
Parma just finished talking about regulation.
Okay, so let's change the order somewhat then. No, so I find it striking because we're talking about technology development, but we find ourselves talking about policy over and over again. I think this is what we really need to talk about, policy going forward. So a lot of the questions is also about what's going to happen. How will the world be in 10 years? And the answer is we decide how we want it to be in 10 years. And not completely, of course, because there's no such thing as the perfect policy. There are unintended consequences, et cetera, et cetera. But on the general line, will we regulate? Yes or no? Will we get the regulations right? That makes a huge difference on the world in 10 years. Will the US issue a digital dollar? Yes or no? That also makes a difference in terms of 10 years. So I think policy decides most of the things, what will happen in the future. And that covers crypto, it covers CBDC and the world in general. So I end it there and I pass over to Parma.
No, I mean, Gabriel's done a fantastic job summing that up. But I think it's quite important for us to realize that when it comes to regulation, at least from a personal perspective, you're looking to really harness as many benefits as you can from these technologies and these crypto assets while managing all of the risks that we've explored. So when we talk about bans, look, where in those emerging jurisdictions where crypto assets might be systemic or close to being systemic, it might warrant some form of restrictions in the short term. But these restrictions and bans over a long term, I don't think are policy options that are feasible. More feasible, sort of building, ideally global standards that can be implemented across jurisdictions to reduce market friction, to reduce regulatory arbitrage. But in the absence of those global standards, domestic policy that looks to manage the risks from some of these centralized intermediaries like wallets, like exchanges, I think is very sensible. And then when you look at stable coins and the potential for them to be systemic, I think some of the proposals being shared around bank-like regulation or payments regulation, depending on their use case, I think can form a cornerstone of robust regulatory.
Thank you very, very much. Thank you to the eKernel team, Nicholas, Chris, tremendous partners to make everything run very smoothly. Thank you to Robin, Mijica, and the whole EMI team who are behind the organization of the webinar, and thank you to the speaker. I just wanted to add, it's very interesting to say I was in favor of dollarization because I was, and I am understanding the cryptoization and the CBDCs because many of the emerging markets problems stem from the fact that the debt is in dollars and you have to repay the debt with a currency that keeps the value in Argentina, Zambia, so many other countries that face the same problem. It's not, the country is too small to be able to control the currency, and the country has to pay in dollars. So it's not that the debt continues to double or triple, it's just that the currency, the value is 100% or 200%. So we are in a situation in which emerging markets want solutions, and that is, they see it as one. Will they be risk, as Dimitris is saying, will cryptoization end up being dollarization? So definitely the same problems. So remains to be seen. And of course, the US is not in a hurry for a CBDC or a hurry into adopting cryptos because the dollar has the value and is still today, as you very well said, Gabriel, the reserve currency of the world. So no hurry to change when this is working extremely well. So we hope at the end of the day, the hope is that cryptos, CBDCs are not the same, but definitely we see this early adoption as the rush for adoption, help emerging markets to leapfrog and help those, in spite of all the risk, help the population who has not had any access to financial services have access or facilitate the access for the financial services they deserve. The first conversation of many, looking forward to continue the conversation in next webinars and offline with all of you. Thank you to the audience and thank you for your questions. Thank you very much.
Thank you for having us.